Hi there, welcome to Kneppy Invest, and welcome to my pursuit of high quality companies. And in today's video, we'll be looking at a company called TransDigm Group, listed on the New York Stock Exchange with the ticker code TDG. It's a pretty big company, about a market cap of $80 billion. And you can just see here, this is their webpage. You can see some helicopters, some airplanes. So yes, TransDigm Group does manufacture parts for airplanes and maybe other aircrafts as well. In fact, if you go to the overview section, right at the top, they say their parts are represented on nearly every aircraft in service. So you can sort of understand why this company has a market cap of $80 billion. Something else that was interesting here, they just mentioned that this company is comprised of 51, yes, 51 independently run operating units. So I'm wondering if this company has been heavily acquisitive in the past. So that's one of the reasons why they have grown, or how they have grown, is just to acquire and continually acquiring new operating units. In fact, if you go into the operating units section, they have the names of some of these units, maybe not all of them, because I don't think that is 61, or could be. For instance, Champion Aerospace, CMC Electronics, Dart Aerospace, High Tech Finishes. I've never heard of any of these, by the way. Marathon Norco Aerospace. Lots of aerospace type companies in here, as you would expect. US Cargo Systems, Whippany Actuation Systems. There you go. So that is just some of the operating units they have in existence. They also sort of name drop NASA down here. For instance, they say TransDigm businesses produce products ranging from aircraft passengers' seatbelts and cockpit security systems that keep passengers and pilots safe, to parachutes that protect and save the lives of members of the military, to equipment that helps deliver NASA rovers to new planets. That's probably the most interesting aspect of this company, I think, even though I don't know this company at all. Okay, so what I'm going to do in this video is I'll briefly go through the screener that I used to extract TransDigm Group into my universe, and then we'll have a look at some of the financial metrics of this company. Would I describe TransDigm Group as a high quality company? Could this be a company or new addition to my high quality portfolio? Okay, so I did develop this screener quite a bit ago. It was a fairly broad screener. A lot of companies popped up on the New York Stock Exchange. So this is just for the New York Stock Exchange, 250 hits. And I have gone through this. Now, I have developed, since creating this particular screener, what I define as a rule of 20 high quality. And I can almost guarantee you, TransDigm Group did not, or was not hit, or was not filtered in to this rule of 10. In fact, we can verify that. So let's just have a look at this rule of 20. We'll have to change exchanges. In fact, in my rule of 20 screener, only 133 companies were hit instead of 250. TransDigm Group has a market cap of 80 billion, and it's not there. It is not there. So why is it not there? Well, the reason is the revenue growth, in fact, has been, over the last 5 years, is actually below 10%. For TransDigm Group, if I can get right there, TransDigm Group revenue growth over the last 5 years is only 7%. Total return since inception, 30.4%. Earnings per share growth, 14.9%. Return on equity, negative 37% over the last 10 years. So this was something that was of interest to me. Why is return equity negative? Does that mean that equity is negative? And why would the equity be negative? So this was actually the first question I sort of was thinking about when I went through these numbers. Free cash flow yield of 2.1%, P ratio 53.9, gross profit margins 59.8. So there are a few things to like about TransDigm Group, but again, it's that return equity, negative 37. Does this company have negative equity? Because otherwise it'll be sort of dashed. There'll be no return equity if they didn't have any earnings. Okay, so that's the only thing I can think of. Okay, so now let's have a look at this company just to see how I would define TransDigm Group. Are there any red flags or anything like that? So let's do that right now. Okay, so first thing I always do is just have a quick look at the overview. Now, this company has a fairly big market cap, almost 90 billion. Enterprise value, 112 billion. So this company has a little bit of debt. In fact, net debt of 22.64 billion and debt to equity negative 4.4. So it does look like this company has negative equity, which is intriguing. And maybe one of the reasons behind that is because they are highly acquisitive and they pay their acquisitions through debt. So they just keep building up their debt and debt. And I actually did verify that, by the way. I just actually asked ChatGPT. So I'll show you ChatGPT's response to my debt question. Now, typically the first thing I look at when I'm researching a company is revenue and earnings growth. So revenue growth over the last 3, 5, 10 years, good enough, pretty nice. 13.1% over the last 10 years. Earnings per share growth at 22.8%. Now, if they were funding these acquisitions through equity, say through shares, capital raisings, you might see a much bigger difference between revenue growth and earnings growth because they're diluting shareholders. But it does seem like, according to ChatGPT, they've been funding acquisitions through debt. Next thing I always look at is margins. Gross margins, 59.8%, pretty nice. But I also want to see how these have been changing through time. Operating margins, 46.6%. It's pretty nice. Return on equity is negative again, and return on invested capital, positive, 14.3%. So that's actually positive, but again, negative return on equity. I don't really care about dividends. P ratio, 53. Enterprise value, actually, if you included debt, so with the enterprise value, 112 million, is price to earnings a really good indication of the valuation of this company? And I would say no. I'd probably prefer to look at, say, EV to EBIT or EV to EBITDA, EV to free cash flow, something like that, just because of the amount of debt this company has. Okay, so let's just have a look at the financials. Now, revenue, I will have a look at revenue growth and profit growth. Pretty nice. This is exactly what you want to see. This is exactly what I like to see. Everything's growing through at time. No, it's not growing in a straight line. There's been periods here where it's gone backwards, particularly back towards COVID-19. We did see profit and revenue actually drop during that period, but it's risen nicely since then. So everything's tracking in the right direction. Probably a big question I would have is how much organic growth there is, or how much is this growth in revenue and earnings because of acquisitions. But we have seen that earnings per share growth has risen, but that's because they've funded acquisitions through debt, not through capital raisings, according to ChatGPT. Another I like to look at is how are gross profit margins and operating margins changing through times. So we'll have a look at that right now. In fact, I'll put in both because in Fiscal AI, you can make some of these invisible. There we go. First thing I'm going to look at is gross profit margins. And in fact, gross profit margins have been increasing over the last 10 years. Now, from 54.2% to 59.8%, that's a nice little increase. There's a little bit of dip during the COVID-19 period, but that's okay. So over time, gross profit margins have been increasing. What about operating margins? We want to see this increasing as well. And yes, slowly increasing as well, apart from that dip in COVID-19. So everything's looking pretty good for TransDigm Group. And that's exactly what I was thinking when I went through this the first time. Now onto the balance sheet. And I just want to confirm that equity is negative. And yes, equity is negative and decreasing. Well, decreasing, going down and down. So yeah, net equity has been decreasing, currently around about negative $6.3 billion. And of course, I just want to know why. And it is, of course, the debt. They have $24 billion of long-term debt. They also have a fair bit of cash, I think. Yeah, $6.2 million of cash. So if you have a look at cash as well, and we'll get rid of you. So debt has been increasing, continually increasing, and cash has been sort of going sideways. So this is actually, for me, a fairly big red flag that debt has just continually increased, up to $24 billion right now. Pretty high for a company that has a market cap of 80 odd billion. So this is actually a red flag for me. And this probably pushes TransDigm Group out of the high quality spectrum. That's just for me, because debt is quite important. I don't like companies who continually increase the debt. And there is another reason TransDigm Group doesn't fit into my high quality spectrum. And I'll show you that when we look at ChatGPT's response. Okay, so that's all I'm going to talk about when it comes to TransDigm Group's financials. Now, let's have a look at what ChatGPT told me when I asked it. Why TransDigm Group have so much debt? Very simplistic prompt, but ChatGPT can be quite smart. Here's a snapshot of TransDigm Group's current stock performance. I didn't ask it that. Not sure why it gave me that, but then it gave me some interesting answers. So, okay, first point, aggressive acquisition-driven growth. So the company operates like a private equity firm, constantly acquiring niche aerospace supplies to boost its portfolio. Since 2010, long-term debt has skyrocketed from $1.8 billion to over $24 billion. These purchases are including big deals like Ursuline, $4 billion in 2018, and others totaling over $2 to $3 billion annually, are almost entirely debt financed. There you go. Leverage private equity playbook. They use heavy leverage to acquire and selectively invest post-purchase. They often cut R&D at newly acquired units to maximize cash flow, which is then used to service debt and improve returns. That is a slight of a red flag to me as well, because research and development is very important for future growth. So that signifies a deliberate high-risk, high-return strategy. Debt-funded shareholder paybacks. TransDigm recently borrowed $3 billion to pay a special dividend. This is a massive red flag for me. To borrow money to pay a dividend, that's a big cross for me. In the first quarter of 2021, their $4.2 billion dividend slashed cash reserves, pushing debt closer to $25 billion. This reminds us they prioritize investor returns, sometimes over conservative capital structures. And then stable, high-margin cash flows provide cushion. Despite elevated debt, TransDigm generates strong cash flow. Operating cash was around $752 million in a quarter, with robust EBITDA margins. Analysts note the cash coverage is sufficient to manage obligations, and lenders are generally comfortable renewing maturities due to continued profitability. So it's not accidental, it's intentional. I just don't like what they're doing. That's not my... And there's so many opportunities in the market that when you do see a red flag like this, you don't have to go in there. You don't have to go in there. I'm just going to go back to their financials and have a look at cash flow. So let's go to the cash flow statement. And I like to have a look at cash from operations. And I also like to have a look at free cash flow, just see how much different they are. And they're not that bad, but in the last year, they had operating cash flow of $2 billion and free cash flow almost $2 billion. So if you have a look at the market cap of the company, even the enterprise value, it's okay. Nothing that bad, but yeah, I don't know. It's just a few red flags I did find within the company, particularly the borrowing money to pay a special dividend. That's actually a really big red flag for me. I don't think that's very prudent capital allocation. Anyway, that's for me. That's just me. Anyway, so would I define TransDigm Group as high quality? No, because there are some red flags. Particularly the negative equity is actually a red flag for me. That's another red flag. And let's just have a look at their chart. Now, just because I have red flags doesn't mean this company can't be successful, but it's just me. There's some things I don't like to see. Now, if you have a look at the chart, and we'll have a look at the weekly chart, and we'll put in and it has stored. We'll put in the 200-week moving average. And this chart is actually the chart of a high-quality company. Share price remains well above, maybe not well above, but does remain above the 200-week moving average. On occasion, it has hit the 200-week moving average and bounced higher. Only once has it fallen through the 200-week moving average, and that was during the COVID-19 period. But you can see, actually, the share price popping off, or bouncing off the 200-week moving average a few times. 1, 2, 3, 4, 5 times in the past 10 years or so. So if you just was really lazy and you just wanted to have a look at the weekly chart of a company and you saw this particular chart, you would probably say that this is the chart of a high quality company. So maybe, what do I know? What do I know indeed? Okay, that's all I have for TransDigm Group. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.